Have you ever wanted to invest in multifamily real estate, but you just didn't really know how? Maybe you didn't think you had enough money. Maybe you didn't think that you just had the wherewithal to get it done for one reason or another. Well, today, this is part two with Dave Seymour. You know Dave, Flipping Boston, the Flipping Formula, the education program. He's been on ABC, CBS, MSNBC. You name it. You name it. The alphabets go down the line. The man's accomplished, right? So we're going to talk today about how he's doing his multifamily investing, where he's doing it, and why he's doing it in that particular area. Of course, along with the mindset things that come along with it. So enjoy this Real Estate 360 podcast, and I'll see you on the other side. Peace. Turn up, turn up, turn up, turn up. Yes, we are back. We are back. Real Estate 360. Welcome, welcome, welcome. And this is part two with my man, Dave Seymour. Good morning, sir. How are you today?
Jason, I'm great, brother. I'm great. You know why? Because I choose to be every single day.
That's right.
That's it.
That's right. So now, last episode, we talked a lot about mindset for the beginning investor, and really it applies to any level of investment, to be on our investor. Sure. To be honest with you, because it's all mindset. We all need and want to get there, and we know that there are people at a certain level that, in terms of their level of achievement, that understand the importance of having a mentor, having coaching on a consistent basis, right? So in today's discussion, I wanted to get more in depth as it relates to what you're doing now. Okay.
Sure.
I've explained to everyone, and if you don't know, if you didn't listen to last week's, this is Dave Seymour, star of A&E's Flipping Boston. He's been on CBS, ABC, CNBC, Fox News, and many others just like it. He's a retired firefighter. He did that for 16 years. He's been investing now for the better part of, if I may, 2 decades.
I know I don't look like it, man.
And he's partnered with Kevin Harrington of the Shark Tank, and they have put a private equity group together that's just changing the way things are done in the commercial real estate business, allowing or making it accessible to people that don't have, $10 million or even $1 million for that matter, to throw in. They're making these deals real for the everyday average guy who wants to invest, or person, that wants to invest in real estate. So that's who we're talking to. We're talking to someone who is extremely accomplished. He's done many, many different things. He's shared the stage with a lot of people, even had his own, and probably still does, his own educational program, which I had a great opportunity to work with him on. So that's who you guys are listening to right now. And what we're going to be talking about today is commercial real estate and how you transition into that and what that means for you right now.
Sure. No, great stuff, Jay. Thanks for doing this with me, man. I just enjoy, sharing knowledge, as we now say in the cool kid clubs, dropping some bombs. But look, on a serious matter, in January of this year, I was building a business, hard money lending, and I had 7 loan originators, 1,800 square foot office facility. I was ripping a $50 million line of credit for house flippers to be able to have access to capital asset-based lending. And we had about 15 million in the pipe ready to close, and then COVID hit, and my business model was broken. And the reason it was broken, Jason, is that line of credit that I was working from with the hard money lending was dependent upon Wall Street buying our notes. Mm-hmm. And Wall Street turned around when COVID hit, and their tolerance for what's called non-QM loans, or non-owner occupied loans, investment loans, was over. They had no interest in it, and it put me out of business in 3 days. The investment into that business was not substantial, but nobody still wants to learn, lose $40,000, $50,000, which is what we we ended up taking a hit on.
Mm.
So look, entrepreneurs do one or two things. They either cry, sit in the corner and never come back, or they come back with a vengeance. And we came back with a vengeance. Partnered up with a very dear friend of mine, guy I've been in business with for maybe 2 or 3 years in some other structures. Walter Novicki down in the Gulf Coast region of Florida.
Mm-hmm.
And what he had been a prolific syndicator. And a syndication is where a group of investors come together on one larger project, either a ground up development project or, maybe an apartment complex, office complex, retail. And then that syndicated group takes down the bridge, the money needed down, and then the bank will come in and finance the rest of these assets. And the guy had done about $250 million worth of business in the past 15 years down in Gulf Coast, raised about 125 million in private equity, investor capital to do these deals. So anyway, long story short, we got together and said, hey, what do you see? What's the opportunity that's going to be created? Because when everything is in chaos, somebody else's misfortune has always been somebody else's fortune. That's just life. And you can either, look at it from one side of the equation or the other. And, 2008 created the biggest transference of wealth our country has ever seen.
Mm-hmm.
And it's happening again now. And those that realize it and are prepared for it are going to be the winners. Luck is defined as when opportunity meets preparedness. The opportunity is now and we're prepared. So what we did is we created a Securities and Exchange Commission approved fund. It's called a 506C Regulation D fund. And it allows us to raise capital from private investors to buy institutional quality investments. And what we buy is 40 to 150 unit apartment complexes only in the Gulf Coast region of Florida. And the reason we do that is because we've got a 20 plus year track record in that market. All the verticals are in place, Jason. I've got contractors, property managers, I've got the right real estate team, etc. Everything is already established because of what we've done in the past. Now, what that allows us to do is to bring these quality investments to the community. Now, the community that we invest with, this is important, is what's called an accredited investor. Now, an accredited investor is determined by the SEC as an individual that earns $200,000 a year or more, or a family unit at $300,000 or $1 million in net worth. So these aren't for the guy who's got $5,000.
Yeah.
If you've got $5,000, go to a crowdfunding platform and see what kind of returns you can get, and that's fine. We work with what they call sophisticated investors. So we're buying as much real estate that fits our buy box, and we have a specific type of asset that we buy.
Absolutely. So are you buying A, B?
Yeah, great question. We buy B-class facilities, 1990 or newer. We buy what are called core plus. Core meaning they cash flow, plus meaning there's a position in there where we can create more NOI, net operating income. Mm-hmm. We either do that through underperforming management, which is 90%, I would say, of the deals that we buy. Mom and pop organizations that don't know how to run a facility the correct way. And also deferred maintenance and rent challenges. A lot of amateurs, and I'm sure you've experienced this as well, a lot of amateur investors in the commercial world, they won't raise rents for fear of losing a tenant.
Correct.
Where, professionals, we give the tenant the very best experience they can. And the law of reciprocity says if they are happy and healthy and safe and taken care of, the law of reciprocity says they don't fight and they don't leave when we raise rents. And when we raise rent, we do what's called an inconvenience, maybe depending on the marketplace, $40, $50 a month, something like that. But when you do that over 150 units, that's a substantial increase.
Absolutely.
Substantial increase in net operating income, creating the ability to offer double-digit returns to our investors. So it's a business plan. Everyone is a business plan, and you put them all together in one big fund, and then it becomes a machine that just trucks down the road. It's a juggernaut of investments.
That's right. Now, there are a lot of different models. You'll see a lot of different syndications out here that are offering different types of returns. Some are offering equity, some are offering preferred interest. How does yours work, or does it fluctuate from deal to deal?
Yeah, great question. So we have real estate fund, Freedom Venture Real Estate Fund, which is what's called a blind pool. That's a blind pool that buys a specific asset based on our buy box. That pool gives our investors a preferred 6% rate of return, and then an upside share on everything over 6% with us as the general partners of the fund. So we put as many assets in there as we can under that group, and then our investors are buying shares in the management company. It's a minimum investment of $100,000. We target out our returns, quarterly distributions to our investors, anywhere between 10 and 14%, depending on where the assets are at any one time. They share in the cash flow, so it cash flows. We buy cash flow to pay the distributions to them, and then they also share on the equity at the time of execution. So we dissolve everything in the fund, 5-6 year exit strategy, depending on the market, and then they participate in 75% of the upside at the time of dissolution. So our investors are looking to receive 20 to 22%, what's called IRR, or internal rate of return on their capital over the life of the investment. And that works out to be a 2.4 to 2.8 multiple, meaning for every $1 they put in, 5-6 years later, they get an additional $1.4, $1.8 back. So it's a way to turn the capital with velocity. That's in our fund structure. Now, outside of our fund structure, we identify what are called value add. A value add is a more aggressive return profile. The value add also is a shorter term, 2 to 3 years, 24, 36 months. We have one of those under contract right now. We're in the middle of a raise. It's 81 units. It's in Eustis, just north of Orlando. Super property. Incredibly badly managed, giving us a fantastic opportunity to get a nice multiple in there around 1.8 to 2.4. The multiple is smaller because the duration of the loan of the investment is shorter, but we're still targeting out 12 to 14% cash on cash return, and that's a $3 million raise for a $7.5 million acquisition for those 81 units.
Now,
so it all depends on the palette.
Absolutely. Yeah. Now, even with your value add situations, are you still looking for those 1990 or newer that just got beat up for one reason or another? Or are you looking at other kind of asset classes there as well?
Yeah, that's a great question. So this is technically a C-class asset built in 1970. However, all of the big ticket items have been done by the current owner. Tin roofs, all of the Florida hurricane code is all up to scratch. Some nice interior fixtures that have already been taken care of. So it's, by age, it's a C-class property. By, design and functionality, it's a B-class property, but it's in a B-plus neighborhood. So if you can buy the worst, it's the same adage, man. You buy the worst property in the best neighborhoods, bring it up to neighborhood standards, then you're creating value in the asset. So we look for opportunity in the value add space, and we find it where we can. Our inbound lead generation is just humming. It's there's no outbound marketing because of the relationships that we've established. We're getting leads from small banks, big banks, realtors, sellers. It's just everything that we've prepared for is now coming to fruition.
Now, how many units? I'm kind of getting ahead of myself, but in 21, what is your forecast for acquisition? Maybe not unit count, but in asset acquisition. Yeah, great question. So we've got an 8 unit. Now the fund is new. So the history is old, but the fund is new. Right.
So we're taking down 8 contracts this month, the 81 unit next month, and we've got a larger asset coming from one of our banking relationships that's in underwriting right now. That's 286 units. By the end of Q2, start of Q3, as it stands right now, there'll be about 100 million in assets under management. 100 million in assets under management represents a capital raise of around 30 million, which we're confident is committed. So that gives you insight into our leverage position as well. We don't over leverage anything we do more than 65%, which also increases cash flow for our investors. If I'm the way things are going right now, we will have anywhere between 250 million in assets under management by the end of Q3. We anticipate 300 million by the end of Q4. It could be bigger than that, depending on the deal flow and some of the institutional lenders that we've been, institutional investors that we've been talking to. These are the folks that can write checks for, 30, 40, $50 million. They're waiting in the wings, ready to pounce on our deal flow as well.
Absolutely. And I want to make this clear to the listeners, okay? This is a situation that has been put together meticulously. It isn't a matter of trying to learn how to be an operator. They already have the people, the staff that are, they're the operators as the general partner. And you as the listener, let's say, hey, listen, I want to call Dave. I want to get involved in something like this. You would then become a limited partner in this organization, which means you're putting your money up for a preferred interest rate with a plus, a plus on the backside, and you're either going to decide to get into a value add situation, as Dave just explained a little bit ago, or the core plus opportunities that are a little bit more stable and longer term. Okay.
It's interesting, Jason. My investors are doing both now. I've got a call this evening with a physicians group that we spent some time cultivating that relationship. Just good guys and girls. They're just so busy in medicine. They don't have time to put their money to work. They're highly paid technicians. But, a lot of these guys are just looking at doing both. They they'll put maybe $500,000 in the fund for the longer run, and then they'll turn the capital faster, $500,000 in a syndicated asset. So there's a palette for both. It's diversification really at a high level. So it all depends on what somebody's looking for. They want to test this out, then they'll come in on a syndicated deal. When you start paying distributions, people feel good, man. It's as simple as that. We made our first quarterly distributions this past week, and the investors are already clapping and high-fiving, and then they start talking to other investors, and you get some motion behind it. So again, it's palette. What do you want? What do you want to achieve? Are you sick and tired of looking at your 401k ride the roller coaster of death? Are you putting money and hoping that the bond market goes over 1%? You know what I mean? Come on.
And that's what it is. And you're looking for people's safe money, right? You want people's safe money. And what does that mean? That means you're not going to miss it, okay? You're not counting on it to buy groceries or pay the water bill next month.
Correct. We call it lazy capital, Jason.
Yeah.
Because there is a ton, and I mean it, a ton of dry powder, lazy capital in the market right now. Lazy capital meaning, the fool's bet, leaving it in the bank, so the bank can just lend it out and make money on your money. The bond market is killing capital. The amount of trillions of dollars that our government has printed has just created an inflation crisis that is yet to manifest.
Well,
watch out when that really starts
exactly.
up,
But that coupled with the mandatory annual distributions that are going to continue.
That's correct.
Okay, so these we're talking trillions of dollars in the market, and I'm kind of getting off topic here. I'm on topic, but I have a lot of conversations with people about how to raise money. There's no money. I don't know anyone with money. It just. I want to pull my hair out when I hear it because you're surrounded by it. Just because you can't see it doesn't mean it doesn't exist, Right. And it's the process that you go about talking to people and doing that. And as you so eloquently put in our previous podcast, you get now to sit in a room with people that are uber wealthy. Okay.
Sure.
And maybe they're not investing with you, maybe they are. But what they are doing is saying, hey, here's some opportunity. Or, that's not for me. We're buying, $1.5 billion of this, that, and the other over here. But here's a fund that does this. Here's a fund that does that. And now you are a part of that very, very small group of people that people are pointing the finger at Dave Seymour and saying, you know what, your dollars are better invested with a guy like Dave.
Yeah. Look, it's the guy who trained me early in my career in multifamily investing. He said to me, "It's just zeros. It's more zeros in and more zeros out." And when you can get your technician worker mentality and put it off to the side somewhere, and just realize that it's a mathematical equation, which is based upon fundamental implementation. Do you have the team to do the repairs, to manage the assets, to deal with the tenant challenges, to reposition? And if you have all of those pieces of the puzzle in place, then money wants to go to work. I honestly believe that. I believe that capital, if it's not working with velocity, is screaming to get out and go to work. We have a responsibility as entrepreneurs to get the very best yield, options in front of these investors, so that the story makes sense. And every asset we take down is its own business plan, and every asset has its own story behind it.
Mm-hmm.
And if the story makes sense and the operators execute, then the money follows. And look, man, I've been at this game a long time. I didn't get up this morning and say I'm going to be a commercial real estate syndicator and fund manager. I was thinking about this though. My first deal was $5,000, a wholesale transaction, all those years ago, and I was waiting for the cops to show up because it felt illegal.
Yeah.
You know what I mean?
Yeah.
Now this many years later, I was on a call 2 days ago with a funding group out of Chicago, and the guy said to me, he said, "David, we have $2.5 billion that we wished we could have invested every single penny of it from 2008 to now."
Mm-hmm.
It was always the lead generation and the operators with the challenge. And that's the kind of conversations that you can have.
Yeah.
Right. If you stay the course, if you stay the journey and learn from people who've been there before you. So we're blessed, bro.
That's right.
Very blessed.
And that's the most important thing. And as you're moving around, and again, your focus right now is in the southeastern of southeasternness of America, Florida.
It is. It is.
And is that
number one retirement community in the country, bro?
That's right. And is it Central Florida?
No, we're in the Gulf Coast region of Florida.
Okay, so
Route 41 up the coast, I-75 up the center, and
Yep.
we work that out. Our picking is all the way from Fort Myers, Tampa, all the way up to Orlando.
That's beautiful. There's truly a lot of opportunity there. I was looking at a deal it's a smaller deal. It was a 24 unit in Melbourne that needed to get taken care of. Too many other issues with that property. A lot of liens. Didn't want to deal with it.
Oh,
Wasn't.
Really?
Yeah. Hey, listen. I'll buy a problem if it's cheap enough, but that was not cheap enough.
Right. Right.
So
it's got to make sense.
That's exactly right. Melbourne's a great place. It's far enough inland for me. I really enjoy it. Right. But having said that, guys, Dave, as I have said earlier, enjoys speaking to people. He enjoys talking to the potential investor on one level or another. It doesn't matter what it is. If you have an interest in speaking with Dave about his fund, I just want to put that out there before we close out. It is Dave at freedomventures.com, correct?
Freedom Venture. Go to freedomventure.com. Jason, I'm old school, man. You can pick up a phone and call me, 781-922-4418. My answering service will grab the call. Just let them know, hey, I heard you on Jason's podcast. Let's have a 5-10 minute conversation.
That's right. And I'll make sure I put this in the notes as well.
Money. Yeah. Just because somebody has the money, it doesn't mean they're a fit, Jason.
Yeah.
I turn away capital. We got to be on the same page, man. Because basically we become business partners, right?
That's right.
781-922-4418, freedomventure.com. There's great education there as well. So just immerse yourself, learn, and then we can put your money to work if you want some targeted double-digit returns.
Mm-hmm. And I think that is an extremely important aspect of the multifamily space that we're going into right now. We're watching people wait for the retail commercial stuff come on the market, but I think that's going to be a shifting space as we move forward, at least for the next 5 to 10 years. It's going to be that's a longer play, and who knows what that's going to look like in a decade because of what we just went through, right? Or really what we're still going through.
My investors want cash flow.
Yeah.
They want to get paid, right?
Yeah.
The uncertainty in the marketplace requires cash flow.
And that's the difference.
A retail deal, a strip mall. My Lord, I don't know when they're coming back, if they're coming back, man. So,
that's right.
Put your money with Freedom Venture Investments and enjoy cash flow, which creates security, which creates confidence, right?
That's
Rather
right.
than hoping you're getting paid in the future. You get paid on a quarterly distribution and a large chunk of change on the back end. It's not a bad way to grow retirement and grow capital.
That's right. And for a lot of the listeners that are listening, and you're a part of that group that have to take those annual distributions, one of the things that you're looking for is cash flow. I mean, you're asking yourself questions. Do we pay off the house? Do I pay off all the other debt? Or do we try to reinvest this somewhere? And if we do, what does that look like? How safe can it be? Do we want to put it back in the stock market? Well, if you're one of those people that are forced to take those distributions right now, and you're looking for a place to safely put your money because you need cash flow, you got to live, right? You got to live. This is what you do. Paying off the house, the car, that's not going to help you for what you want. Reducing debt doesn't help you live. And I know that goes completely against what Dave Ramsey has to say, but you know, but
and Susie Armand.
Yeah, exactly.
They talk to technicians. They don't talk to entrepreneurs.
Exactly. But people need the cash flow. Older Americans, older people in general, are needing the cash flow, especially when they're in that class that has to take those distributions. So this is for you guys. This is for you guys to find more information about, to see what it can do for you and how it can help you live the life that you've envisioned for yourself all those years ago when you started your career. This is what it's about. This is what it's
Good
about.
Stuff, man. Good stuff. We're here to help.
That's it. And listen, guys, I want to ask you one more question before you get out of here. One more question. Okay.
All right.
What are some of the challenges that you're facing in your specific market today, geographically and socioeconomically?
Yeah, I've got more deals than I can fund. That's it, man. I've got so many great deals that are coming through our underwriting team. It's getting all the capital to put them together. It's as simple as that. The Gulf Coast region of Florida is exploding. Everybody left New York. Everybody left Boston. Everybody left, right?
Yep.
We do business in the states that are landlord and entrepreneur friendly. Not buying in New York, not buying in Boston.
Stay out of Illinois.
That's it. Chicago, Illinois.
Stay out of there.
Chi-town's hurting, bro. Chi-town's hurting. So, more money, because we got the best deals to put the capital on.
Yeah. Well, Dave, listen, I want to thank you again for being here. You guys go check out the last episode as well, and make sure that you subscribe to this podcast. There's always a lot of great content here, and engage with us. We want you to engage and tell us what you like, what you don't like, what you want to hear more of, what you want to hear less of. Share with us what you like, and make sure you reach out to Dave. Again, Dave's telephone number is 781-922-4418, and you can go to freedomventure.com and get more information about the fund, see what's going on there, and start to build a relationship. See what this can be for you. Dave, thanks, man. I appreciate your time.
God bless you, brother. Be well.
Take it easy, man.
Turn up.